This week in the headlines are all about a housing freeze and how this is the worst sales in years. But they are focusing on the wrong data if they're trying to correlate this to some kind of market correction.
Yeah, I guess some of these TikTokers or whatever you want to call them, they didn't go through 2008 like I went through 2008. So I'm looking at very different sets of data, and it's. I guess it's okay when you take a look at something and it goes down like a very, very small percent and you say, we're crashing. And that's kind of what I think is happening in a lot of cases. But having gone through a couple of these personally, we're not even close. I mean, there has to be some very, very significant things for any type of a crash or major correction. The first thing is, you have to have an oversupply of something, period. Like, let's just start there. You have to. Like, you can't. In 2008, there were 4 million homes, 4 million, on the MLS. It took years for that to sort itself. Then, because of the extra supply, prices went down because as a buyer, you had lots of choices. Right now, we just got to like 1 million, like on the MLS today. And don't forget, we're at an all-time shortage. There was from 2012 to 2022, there were almost 16 million new households, but only like 8 million new houses built. So we're not keeping up with the supply at all. So we're undersupplied, and so the math doesn't work on any of this.
Well, first, let's dip into what the headlines are saying for those of you that have not been reading on this. So they're saying that housing sales are at multi-year lows, that there's affordability crisis, and that the high mortgage rates are killing the market. But the media is only focused currently on the transaction volume. And the transaction volume is not... It's part of the puzzle, but it's not the full extent of the picture. So let's first look at inventory, like you were saying, right? Inventory is still tight. Now, 2019, we would call our pre-pandemic normals. And then we had extreme shortages in 2021 and 2022. So now that we're in 2026, we have parts of the country that are exceeding 2019's levels slightly, and other parts of the country, like the Northeast, that are still historically low. But nationally, we are still historically low.
Hey, Jerry, can you pull that up real quick? So, okay, what I want you to focus on is all the way left. So let's just call that 2016. We had almost 1.5 million listings. We just went from 980, I think, to about 1 million recently. We might be closer to 1.1 now for listings. So all you have to do is look at the left side of the recession line, which is the gray, and the right side. You can clearly see that we're not back, not even close. We've got like 3 months of inventory. So you can't ignore that even if it went down there at the very far right side, even if it went down, it doesn't mean that it's a crash. That's actually the opposite. What it means is that if inventory is pulling back, it's not good. High inventory helps home prices, right? So it's really interesting. And obviously, we didn't want to go all the way back to 2008. But in 2008, there were 4 million. So you can imagine how much higher it was. That was a real crash, and that is when we saw the first real price corrections. And what happened in the gray area there for the recession is, if you guys remember, the federal funds rate started going down, and obviously we threw all that stimmy money out in the economy during that period, right? Let's call that the pandemic. Well, low supply, low interest rates, and cash drive prices up. So that's what happened. That's what the run's from.
Yeah, and you have to remember, so in 2008, people had to sell, right? And so they had those balloon payments. So you couldn't delist. There was no delisting. Sellers were in so much trouble that they had to sell no matter what price. They also put a lot of times 0% down. So it was super easy to just turn their keys in and walk away. So we're not in that same situation right now. We're also seeing a lot of delistings. So we're seeing record delistings and also record, and then also increased listings, but that doesn't equate to sales. And that's what the media is focused on. But I think the big thing that the media is missing right now is they're not talking about the actual sellers. The sellers are a huge component in market price corrections. And sellers right now are in very good positions. Jerry, if you want to pull up that chart.
Yeah, let's pull up the interest rate chart and show this is a really, really interesting chart.
You have the one with the loans and the percentages?
Oh, yeah. Yep.
So right now, most people, as you're going to see from this chart, are locked into rates that are under 3%. So the majority of loans, if you look at all the loans listed, are under 3%. A huge bulk of them are under 4%.
Let's just stay here for a second, Jerry, because I don't think people understand what this, some people do, but what this means, guys, is if you're sitting in any of these loans, because right now we're in the, mid sixes? Is that right?
We're at about 6 right now.
Okay, let's call it 6. You got to get all the way down into the 4 range, under 4. So you're talking about 2 full percentage points before people are going to unlock this equity. So what this doesn't show is the equity. So if you focus on that box right there, the red box, I can tell you that that's a little over $30 trillion in trapped equity. So the average equity for a home right now is about $302K. That's a lot. So you think about this. This is so different than 2008, where we had 6 or 7 trillion of equity. Right now, if you look at the whole chart, it's closer to 36 trillion of trapped equity. So it's basically in order for there to be a crash, people they're not going to have money. Like you gotta focus on what Danille said. Take a look at the seller. The sellers have equity. They have cash in the bank. It's in the form of equity, but it's sitting in their home. And so rates have to come down easily 2 percentage points before the market's really going to move. Mm-hmm. Because just why would you, if you've got let's just say a lot of people are sitting on these, $300,000-$400,000 mortgages at 3%. And there's no way that they're going to sell and buy something at 4.5 next door or 5 and trade it out for a 6% mortgage. It's just not going to happen. So you got to have the market's out of balance right now because of these rates.
But, a lot of times people say that once these rates come down, we're going to have all this supply hit the market, and that is also going to increase inventory. But the truth of the matter is the reason if the sellers just wanted to sell and exit, they would just sell and exit right now. If rates go down, they're going to be buying something else, whether that's upsizing or downsizing. They're moving. That's why they don't want to get out of this rate. That's why they don't want to get out of a 3.5% rate, is because they want to move and they want a low payment, right? Right now, if they downsize, they're going to have basically the same payment at 6%. And if they upsize, then it's going to be way too expensive compared to what they're paying now. So most of these people, when rates go down and then they would list, are going to be buying something else. And so that is, how things are going to keep moving in the market. But right now, because everyone's at such a high rate, everyone is just kind of stuck.
And let's look at why a seller would sell, because it's an excellent point. They don't sell just because rates go down. They're not going to, they might refinance. You can't assume that people don't like the place they're living in. Right, like a lot of people love their house. They poured their heart and soul in it. They raised their kids in it, and that might be their forever house. So, so people move for all kinds of reasons, right? They retire, they move to somewhere warm. Maybe they do need the equity. Maybe they have a job loss, and maybe they're concerned about that. That's for sure. That's a little different circumstance. I guess you could have a mortgage maturity, but that's not going to be as big of a deal. But most of those people sitting there are just fine. Mm-hmm. They don't need the house next door, a brand new home. And so there's I think when I looked, there was somewhere between 34 and 36 trillion dollars of equity sitting in the house. Now, guess who wants that? Wall Street. Wall Street wants to unlock that so bad, right? Because, and so that's what Trump's just pounding away on this Fed. He's like, you got to get these rates down. You got to get these rates down. What he's really trying to do is unlock all that equity in the form of a refinance, not necessarily in the form of a sell. So, it could be in the form of a sell for sure. All that will do is it'll fuel the stuff that's being listed right now. But this is the trapped equity and the people sitting there with these low mortgages is partly the reason why we don't have that much on the MLS.
Yeah, and I think you have to look at the distress of the seller. So, 2019 was a pretty normal market. So back then, there was 2 to 3% of distressed sellers. Right now, we're at 2%. So the media headlines of, they're going up so fast, et cetera, we're at 2%. So that is the low end of a normal market of the distressed sellers. In 2008, it was 30%. 30% of sellers were distressed. And that is what created the crash, right? Because when you have distressed sellers aren't just going to sell to sell. Like I have a lot of sellers right now that have their properties listed, and if they don't sell it for what they want, they're just not going to move. I mean, there's so many people like that, right? Where they're just sitting, or maybe they're willing to give a little bit, but they're not, if you tell them, oh, you have to sell this property for 25% less to sell it, like they're just not going to sell it. Like, it doesn't make any sense for most people to sell it.
But I also think a component of distress is no money. Mm-hmm. I mean, people forget about this. These folks are sitting on equity.
Yeah.
So, let's say they're in some kind of financial distress and they can't pay their mortgage. Okay, because that absolutely positively could be happening and probably is in many cases, unfortunately. But the fact that they can reach into their piggy bank of equity sitting in their home means it's not going to show up as a foreclosure. It's not going to show up, as going back to the bank because there's a tremendous amount of equity in there to cover they're not underwater. Underwater means that the home is worth less than the loan. Mm-hmm. That's what that means. And this is not the case. Now, if you do look at foreclosures and defaults, it's still like 2.1%. It's really, really low. I mean, there will always be defaults and foreclosures. 1,000%, it will always just be. So, but it's really, really quite low. So, we're not anywhere near a problem. There was an interesting article that came out and measured 100 cities in 2025. 100. 22 had price reductions and 78 had price increases. Okay? Mm-hmm. So, trust me, in 2008, that was not going on. We did not have price increases in 3/4 of the cities in the United States. So, you got to be careful when you're watching these videos because, and it very well could be, there are markets that are in real big trouble, like Austin, Texas is in trouble. Tampa, Florida is in trouble. Some of these markets have corrected a lot, 5-10% already and even more, depending on, but those are, even in 2008, what happened was there were certain markets that corrected 20, 30, 40%, and there were others that corrected 50%. Why would one correct 50% and one correct 30%? Well, it's because the bubble went higher there. Phoenix was one of those. Las Vegas was one of those. So, when you had sometimes you have this run up, and everybody jumps on. Well, it makes a correction harder in that particular market. You're not going to see these kinds of corrections in Midwest. You're just not. You're not going to see them in markets that never had a really, really significant price run up. So is there a pullback in some markets? Of course. But the overwhelming majority of home prices are going up in this country.
Yeah, and I want to discuss rates because everyone's hyper-focused on rates. And I do think rates, since they started dropping rates in September, we have seen an increase in home buyer activity. I think it's more of a sentiment than anything else that, rates are falling. However, rates have very little to do with home affordability because right now we're higher than we have been, the last 10 years, but we're not really that high historically. And if rates were to come down a whole percentage point, on a $500,000 house, that's only going to save you about $250 a month. So this isn't like if rates come down, all of a sudden everything's super, super affordable, because I personally don't see rates going back down to 3%. So if we get an extra 1% down to 5%, I'd say that would be good, but it's only going to save you about $250 on every, 400 grand borrowed.
Yeah. And so no matter, I guess the strategy moving forward is if rates continue to go down, what you're going to have is you're going to have a very, very slow, methodical, sales. You're going to have a little more sales. You're also going to have a little more refinances. I think that under this administration, he's going to continue to push these rates down. Mm-hmm. So what you're going to have is there's nothing wrong, guys, with locking in at 5.5, and then later refinancing at 4.5, and then later refinancing at 3.5, if that is where things are headed. It's just like ratcheting it down. So, if the deal makes sense today at 5.5, then knock yourself out. Go do it. If you're happy, go do it. But to Danille's point, these people that are sitting on these 2.5, 3.5, 4.5% mortgages, they're not even interested. They're getting these refi flyers in their mailbox, but there no way are they going to, because what's going to happen is their payment will go up a lot, even though, and then of course the question is what are you going to do with that money? Some people need it, so I get it. You're going to have that happen, but this is the time to get dry powder, and this is the time to, if it makes sense. I still think these rates are cheap too, by the way. Let's go back and look at history. 5-6% interest rates is historically about average.
Yeah. And you bring up another good point too, is, if they're going to refinance, why would they when they're sitting in such a low rate? And, a lot of these people that are sitting in 3 and 4% mortgages, they can literally rent out their home and make money. And we are seeing that. There's a lot of accidental landlords where they want to buy another home. They never anticipated renting out their house, but they're not selling it for what they want. So they're throwing a tenant in there, making a few $100 a month. And they're just kind of waiting out the market, where you weren't able to do that in 2008 either, because your rates were, you were on these balloon payments and they were skyrocketing and they were way too high. But if somebody can, do creative financing, or somebody can do a sub-2 deal, or somebody can throw a renter in there and they can make money, that helps the seller not have to sell as well.
So if you're sitting at a 2.5% rate, like, you've got one at 2.8 or something, mm-hmm. You're beating inflation. Like, let me just say that again. Like, you're borrowing fixed money at the inflation rate. Like that's gold. No, people are not going to walk from that. There's just not. And we haven't even talked about the equity. Danille's got a lot of equity in that particular house that she wants, by the way. But a lot of people are sitting there looking at, if you have an investment property, you might dump it, take the equity. Maybe you need the cash. But if you're a homeowner, depending on where you're entrenched in your neighborhood and you like your neighbors, or your kids have grown up there, or whatever the case is, why would you refinance? Why would you,
or sell it?
Yeah, why would you sell? And so the lower rates are going to help that obviously people buy on the MLS. It will unlock. There's a lot of people on the other side of that red square that we showed earlier around the mortgage rates. There's a tremendous amount of people in the above 5.2. So millions and millions of people. So there is a market there, but the majority of the market is clearly under 4%.
So we're going to be talking about the job market next, which is very important when it comes to housing prices. But first, here's a paid advertisement from our sponsor, Monetary Metals.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
So confidence in the job market is the big metric to watch. And it's not just the job market, but it's also that important word, confidence in the job market.
Yeah, and by the way, Jerry, not us, found an incredible chart. Jerry, look at this chart that he found. If you exclude healthcare employment, the U.S. has actually lost jobs for 2024. This is an incredible chart. We both, Danille and I both said, is this real? We looked. It's the Bureau of Labor Statistics. So obviously, what does this mean? This means that healthcare is just is going like crazy. And obviously that industry is kind of offsetting our job numbers, but we're still sitting at what, at 4.3 today, which historically, guys, is not that bad, right? It's just not. I wouldn't call it an employees market, right? I wouldn't call it an employers market either, but it's balanced, and I think the Fed's fine with that, right? I mean, that's one of their mandates is low unemployment. I think if it gets any higher, and I think AI is a big wild card still.
Yeah, AI is going to be a wild card. Also, if people aren't feeling secure in their jobs, then obviously, it's going to affect buyers, because a buyer is going to be nervous to buy if they're insecure in their job. So that job market is actually something that can sway the market much more than how many transactions are actually happening in the market, because that statistic doesn't really matter that much. It's more the confidence of the buyer and the distress of the seller.
I'd love to hear from you guys and what you guys are seeing, in the job market, because I'm hearing all kinds of things. I have friends that, they're not laying people off because of AI, but what they're doing is they're growing, and they're not actually hiring people for the growth. It's very interesting, because they're finding these efficiencies with their IT, with their HR, with their marketing, with their accounting, certainly customer service, and they're finding these efficiencies inside of their businesses, and so one person can now do what typically potentially could have been two people's jobs. So I think it's going to be really, really interesting. So I'm a betting man. I think that you're going to start to see higher unemployment this year, personally, as a result of this. I think this is a year for it to show up, because there are people that adopt this technology quickly, and there are people that don't, and it comes slowly. But it's definitely on everybody's radar, and they're definitely taking a look. Because why? Because employers are also suffering from inflation. The employers' costs are more, and so these things are all trickling in, and of course labor costs are driving some of that as well. So if they can drive that down a little through tech, I think this is going to be the year that it's going to start to really show up.
So in order for the sellers to be distressed, because I think that this is the whole point of this video, is the seller distress is what you need for major price corrections. And in order for that to happen, you're going to need to have massive unemployment, not a little bit of unemployment. You're going to need to have massive unemployment without the government stepping in to help. And if you have massive unemployment and the government not stepping in to help, then yes, you're going to get a correction in the housing market. But my challenge to you is, when does the government not step in and interfere? Because even in 2008, the Fed specifically said that one of their regrets was not stepping in to save the housing market. That was a big thing. If you look at the Fed notes, that they were not happy with the outcome of what they did.
Well, I think we got a glimpse of that during the pandemic, right? Like, unemployment spiked, people got sent home, and what happened? the president came out and said, can't evict anyone, and we're not going to foreclose on anyone. And remember, they're kicking the can down the road on people's mortgages and all that stuff. So you guys went through this, all right? Government stepped in. They also gave stimmy money, right? So they potentially right out of a playbook here. So, okay, so it's true that high unemployment potentially could disrupt the housing market for sure. But I do want to point out that distress means no cash. So the first people to get distressed are going to be the renters. The second tranche is going to be the homeowner. And it could be happening at the same time. That's true. But don't forget, when you've got $100,000, $200,000, $300,000 of equity sitting in your home, you're a lot more comfortable than you were in 2008. Because in 2008, the home was worth less than the mortgage. And here, the home was worth significantly more than the mortgage. So, so yes, you might have personal distress. But just like anything, if you guys have a debt and you have cash, you pay the debt, period. And that's exactly what this is going to be. It's going to be, yes, maybe they have to sell the home to get to their equity. I get that. But if they're in trouble financially, they're going to reach into the equity of the home that they already are living in, and that's going to cancel whatever, and it's going to, and obviously in many cases, it's going to be a lot more than they need. So I just don't see any kind of a correction at all.
So the reason, we should dive into the reason the deals are actually slower, and a big part of that reason is the sellers don't have to sell. If the sellers had to sell, they would lower the price to where the buyer needs to be in order to get the deal done. But if they don't have to sell, then they're going to keep the price that they want. And then the buyer, it is a stretch right now for buyers with these rates and these prices to buy. But that's probably not going to change. And unless you have that seller distress, it's not going to change.
Yeah, and so let's look at why a seller would sell. Obviously, if they're Airbnb, if they're an investor, right? Let's say things aren't cash flowing, right? Because the rental market's soft for sure. If the loan's maturing, if they've been relocated, if they've lost their job, if they're retiring. So there's lots and lots and lots of reasons that, people want to leave an area. And what are they giving up? They're giving up that rate. So, but it's so in some cases they have to, in some cases it's a choice. And so you're always going to have that. But to Daniel's point, the rates need to come down a lot for millions and millions more that are sitting on these low mortgages.
So it's interesting that you brought that up, because I was just thinking of like all the houses that my clients are buying, or clients I have that are selling. It is almost always a distressed Airbnb, or it is a elderly person that is going to like an assisted living. Or, we had one where the people were moving across the country, but like very few is, we just want a bigger house. We just want a smaller house. Like even my, retired, people that are going to assisted living, like I haven't had any retirees that are downsizing. I haven't had anyone come to me or any of my clients buy a house where it's like, oh yeah, Joe's just, he's going to go buy a condo. He's living in this night. Like it's not happening. It's literally almost all people going to assisted living. That has been the main buyer pool that at least I've been working with.
Yeah. We have a friend that owns a single older woman, owns a, fairly big home. And, but she's got like a below 3% rate on it. Okay. And the home's too much for her, right? Just period. It is. It's just, she said so. Like the maintenance, the upkeep, you can imagine all that stuff, right? And so the right decision for her is to downsize into something smaller. It's more manageable, maybe in some kind of an HOA or something. And that's actually what she wants. But the lateral move actually makes her mortgage go up.
Yeah.
Like this is a really important point. Like, so she's sitting there with this really, really low mortgage rate and in a home that she actually knows she has a lot of equity in, but she knows if she makes a lateral move somewhere to something half the size, that her payment actually is going to go up. So it's a financially bad move for her. So she's staying put. And I think you guys got to really wrap your head around this. There's a tremendous amount of people in that situation. If they have floating debt or they're getting a divorce, or in Danille's case, what she said with somebody moving into retirement, very different scenario. But the majority of Americans, a lot of them, are just sitting on this really, really cheap money. And their cost of living is phenomenal. The lateral move, even to rental, is more, as you guys know.
Well, that's the thing. It's like, okay, somebody loses their job and they're stressed out about their mortgage payment. If you're in a rate that's 3%, your rent is going to be higher. So do you take out that equity, or do you just figure out, your situation, with the house? And it'd be interesting, those of you sitting in rates below 4%, for you to comment on the video and just say your situation, if you would ever sell, if you had to sell, why you had to sell, if if you're trying to sell but you're not going to move your price. I mean, all of that would be really good feedback, because I think people read the headlines, especially people that don't own anything, and they think, well, prices have to come down because I can't afford to buy and none of my friends can afford to buy, so they have to come down. But the truth is, it really hinges more on the seller than it does on the buyer.
Yeah, and just before we wrap up, there's a lot of studies out there, guys, on, if you look at household formation, let's just focus on that, for the last 10 or 15 years. We're at 16, 17 million, okay? Household formation literally means new households formed, okay? Population grew a lot. During that period of time, coming out of the GFC, not a lot was built. So there's 8.5 million homes that were delivered during that period of time for all kinds of reasons, okay? Yes, post-GFC stuff, but also higher interest rates or whatever it might have been. But the supply never, ever kept up with the population demand. Okay, those are facts. So go take a look at the Harvard study. Go take a look at the Brookings study. Go take a look at Zillow, National Multi-Housing Council, National Home Builders. Go look at Realtor. Go look at all of them. Every single one has a report around all these metrics. And now, while they are all very different, I think that the ones that are not real estate folks, like Harvard and Brookings, are the ones that I kind of focus on. But even those show that we're about 3.8 million houses short. Even those. So now you might find some that say we're 5 or 6 million. You have some that say we're lower. But the reality is we're somewhere between 3 and 4 million houses short. Period. As a result of people and housing. That's all you have to look at, right? So when you have more people, less housing, you're going to have prices that are going to be sitting there. Now, you're going to have pockets. You're going to have areas like we mentioned, like Austin, Texas is in horrible trouble. My business partner in our Limitless event, Limitless Expo, Toro, we just met last week to talk about our Limitless this year. And he's just going after Austin right now. He's going to buy hundreds of houses there this year because it's in a dip. Now, Austin is the capital of Texas. It's going to go through its thing. I bought in 2005. I caught below the dip, and then I rode it out, and it came back. So these cities, they have a life of their own. They grow, they contract, and so there's a time to buy and a time not to buy, time to exit, a time to cash flow, and all of that. And so there are cities. Florida has a bunch of them, and so you're going to, if somebody's talking about that, of course, if they're in that neighborhood and their home prices are crashing, of course, but outside of their little bubble, it's just not the case.
And I want to leave you with this, because I really want you to sit on it and think about it. But 2008 was forced selling, and 2026 is hesitant buying, and those are very, very different markets.
Yeah.
All right, we'll see you guys next week. Don't forget to check out our podcast every Thursday. You can check us out on a podcasting platform or on YouTube.
Enjoy your week, guys.